Bitcoin is back near $66,000 with a completed day of positive ETF flow behind it. US spot. Bitcoin ETFs took in a net $226.8 million on July 20th, according to Farside Investors. That is real demand, but only one part of the liquidity picture. The question is whether Bitcoin is beginning a durable recovery or simply enjoying a relief move that traders may chase too early. Start with the constructive evidence. Price improved, ETF demand turned positive, and broader risk assets initially responded as oil eased on renewed mediation hopes in the Middle East. Those signals can reinforce confidence because lower energy stress reduces the immediate inflation fear hanging over markets. But movement at the same time does not prove that one asset caused another to rise, and an ETF inflow is asset-specific demand, not automatic proof that global liquidity has returned. Price now has a witness, but it does not yet have a full jury. The missing confirmation is the price of money and the durability of the oil relief. The latest official 10-year Treasury reading was still 4.55% on July 17th, while Reuters reported that inflation concerns were keeping yields elevated on July 21st. Brent first slipped below $89 as markets welcomed ceasefire hopes, then moved back toward $89.70 as fresh attacks and supply threats competed with diplomacy. That reversal matters because a renewed oil shock could lift inflation anxiety, keep yields restrictive, and remove the macro support behind the rebound. So use 3 gates before calling this a confirmed Bitcoin breakout. Gate 1 is price. Bitcoin must hold the reclaimed area instead of giving back the move during the next US session. Gate 2 is flow. The next completed ETF print should stay positive rather than turning this into a one-day burst. Gate 3 is macro. Oil and Treasury yields must stop tightening financial conditions because the rally is invalidated if Bitcoin weakens while ETF flows reverse or energy stress rises again. The calm verdict is cautiously constructive, not fully confirmed. Bitcoin has stronger evidence than a headline-only bounce because money entered the ETFs, but one session cannot establish persistence. If price holds, flows repeat, and macro pressure eases together, the rebound becomes more credible. Until then, price is improving, liquidity is offering one supporting message, and patience is still part of the signal.